Hello, everyone, and thank you so much for coming to the seminar today. My name is Nick Muccigrosso. I work for Equity Prime Mortgage here in Central Florida. Our office is right down the street in Maitland, so please come see me when you get the chance. I'm so sorry I'm unable to be there in person today, but wanted to jump in here virtually and give you some additional information from a mortgage lender's perspective as to just some common questions we get during the process. Hopefully, this will shed some light on you. Again, thank you for the Miller Grant and Company team for having me. So, without any further ado, let me jump into a few things I see here and questions I get. Essentially, we just look at three things when we're talking mortgage approval: credit, income, and assets. So when we're talking credit, a lot of people I talk to are very concerned about having their credit pulled. However, it's really not as big of a thing as people make it out to be. You're talking 5 to 7 points off your score. In the grand scheme of things, if your score is in a decent shape, it's not going to matter at all. And if your score is a little on the borderline, it's better to us to know that sooner than later so we can help you improve your score. We have all kinds of ways to help with that if that's warranted. Sometimes you're in better shape than you think, though. Also, your credit report is good for 120 days. So that means if you were to do a credit inquiry in the end of November, as long as you close by the beginning of, or the end of March, rather, you wouldn't have to repull credit again. Again, it's 5 to 7 points off your score, not a big deal in the grand scheme of things, but it's good to know how long that credit pull is good for. A lot of people I talk to, they think they need the 700 or 800 credit score to qualify. And really and truly, as low as 580, you can do an FHA loan. And that's with 3.5% down, standard type of deal. There's also some other loans that will offer you something with a 500 credit score. Typically, you need a little bit more money down for those, though. So we're talking 10% down plus. So ideally, you're 580 or better, but you don't need to have a perfect squeaky clean score. But don't let that dissuade you from at least making the inquiry and talking through that. What I tell people is credit's one of those things. It's not a yes or a no thing. It's a yes now or a yes later. So for whatever reason, we need to do some work on that. We have the resources to help you, and it's better to start today than wait 6 months and realize there's a roadblock there. So credit, one of those commonly asked options. Income. So that's a biggie, right? We take what's called a debt to income ratio. So we take all of your monthly debt. So that's car loans, credit cards, student loans, the mortgage that you would be taking out for the house you're buying. And we divide all of that by how much money you're bringing in monthly. The nice thing is we use your income before taxes if you're a W-2 employee. So even though you probably get a nice chunk of money taken out for taxes, I can use your number before that money is taken out. Things that don't count in your debt to income, like health insurance, electric bills, cell phone bills, some of these big expenses we don't even count. But we use these calculations to determine how much you qualify for a loan. So sometimes we run into a scenario where somebody doesn't qualify for as much as they want, especially now. Let's be real, prices have gone up a lot in the last few years. Interest rates have gone up a lot in the last few years. So you might be finding yourself qualifying for a little bit less than you're looking for. However, there are a lot of solutions for that. The quickest and easiest one is to add a co-borrower. So you can add somebody to your loan that doesn't even necessarily want to live in the house. You can have what's called a non-occupant co-borrower. So this has to be a family member, but it can be mom, dad, sister, brother, uncle, spouse, whether you're married or unmarried. There's a whole bunch of different ways to do that. I've had folks who had their mom, dad, brother co-sign just to help them qualify. So as long as you have a family member who's willing to help with that, we do have to look at their credit and income as well, but they can just help you qualify for more house. Eliminating debt, again, that's more of a long-term strategy sometimes, but I've had folks where instead of putting an extra $5,000 down for down payment, they use that $5,000 to pay off some credit card debt or pay off a car loan. That might get you qualifying for a lot more. So it's important for us to have that full picture when we're taking a look at all that. And then a big thing that's not always talked about, but look for a company that has no overlays. A lot of companies will qualify you off of a lower debt to income ratio. So just because somebody's told you X doesn't mean you shouldn't go look for a second opinion. I found that a lot where somebody went to their bank or their credit union and they said, oh, I can only qualify for X, but maybe there's other opportunities out there. Not all lenders are created equal. So just remember to think of that. And again, these are all things that can be overcome if there is ever a challenge. Assets. This is the last piece of our kind of trifecta here. So a lot of people think, oh, I need 20% down. I got to save all this money to put down. No, that's the good news. You can do as little as 3% down for conventional loans if you're a first-time buyer, which means you haven't owned a house in the last 3 years. That's all that means. You haven't owned in 3 years. 3.5% down for FHA. USDA and VA loans have no down payment, 100% financing. Now you're still going to have to pay some closing costs, which could be 3 to 4% of the sales price of the house, depending upon a few things. But there's a lot of great options out there. In addition, there are a lot of down payment assistance options, which we could do a whole class on. But just know that there are other options that will give you money, whether it's in the form of a loan or a grant or something else. A lot of times it is a forgivable loan or a repayable loan, but if it helps you get into a house sooner, I always say buy now is always better than buying later. That being said, still good to have some money in the bank. I have gotten people into a house with $1,500 out of pocket, but for the most part, I would say try to save between 10 and 15,000. I know that's a lot of money, but even if you don't end up using all that, maybe you do get out of pocket maybe $5,000. Wouldn't it be nice to have another $5, $6, $7, $8, $9,000 to use for moving expenses or furniture or any kind of home improvements you want to do? So it's always good to save. Again, that's something we can help you with a savings plan as far as depending upon your goals and what that's going to look like timeline for you. But just know there are options out there. You don't need the rich uncle with a bucket full of cash to buy a house. And then the last thing I wanted to touch on today, this is a little chart. I know this may not make sense immediately, but this is where mortgage-backed securities have been in the market since earlier this year. This is since June. So you can see the green is good. That means rates are going down. Red is mean rates are going up. So this chart moves opposite to interest rates. So when this chart moves up, interest rates move down. So you can see it's been kind of a downward move all the first half of this year. If I took the chart out further, it would be even a little bit scarier. But we seem to have hit a bit of a point of resistance here where basically the worst is behind us. So most professionals out there, people way smarter than me, are predicting that interest rates are going to slowly but surely go down through the next several months. I mean, right now, yes, we're still in the 6s and 7s, depending upon your scenario. However, as you can see here, in the last really 2.5, 3 weeks, this chart has moved up, meaning interest rates have gone down. So we expect to continue to see this happen. Now, a couple of things from a strategy standpoint. I have a lot of folks who want to wait. They're just like, oh, we want to wait until the rates are back in the 4s or the 5s. I'll tell you, they're going to get there at some point. They always get back to a more normal rate, but I can't tell you when that's going to happen exactly. And the other thing I can't tell you is how many other people are waiting for the same thing, and everyone's going to jump back in the market. So if you have the ability and we put together a plan and you're able to buy now and the numbers make sense, buy now, because an interest rate on your mortgage, your payment is temporary. Most people end up refinancing their loan within 3 years. Especially with the way that interest rates are going now, more than likely you'll have a refinance opportunity in the next 24 months. So again, it's up to you personally. Everyone has their own different opinions on what they want to do, and not every plan is right for every person. However, I'm seeing a lot of opportunity in the market right now. Yes, people are having a slightly higher payment, but they're getting seller concessions. They're getting price reductions. The sellers are working with them a little bit more. Yes, their payment's going to be maybe $200 or $300 higher than it would have been a year ago, but interest rates will eventually float back down and you'll already be sitting on a house. You won't have to go fight in the market with everybody else who's waiting. So just something to keep in mind. Also, one other note that I want to talk on, and this is a little more in depth, but a lot of lenders will try to talk you into paying what's called discount points. So basically you're paying extra closing costs to lower your interest rate. Now, again, every strategy, is not one strategy right for every one person, but I've been advising most of my clients to pay as little upfront costs as possible because more than likely interest rates are going to go down in the next 12 to 24 months. So a little bit of good news on the horizon. A lot of this has to do with inflation starting to subside. Things have started to kind of catch up. Supply chains are opening back up again. A lot of this is kind of post-pandemic craziness happening in the market. But the signs are looking good. We probably have turned the corner. So whether the plan is to buy in the next few months or next year, there are going to be good opportunities out there, but don't totally discount moving forward now because, again, there's a lot of opportunities. Buy now, refi later, and you're sitting pretty. So anyways, that's all I had to talk about today. Thank you for taking some time to be here. I really appreciate the Miller Grant & Company team for having me. Here's my contact info. Any questions come up, please call, text, email me. I'm here to help. And hope you all have a great rest of your weekend. Hope to meet you in person soon. Thank you.